Changes in accounting principle. What if you want to change from FIFO to LIFO? That is acceptable when the new principle is preferred compared to the old principle, and you clearly disclose it on the income statement. For example, you can change depreciation methods. We were using declining balance, but the industry uses straight line, so we're going to go to straight line. Now, I would caution you, it is completely okay to change your accounting methods. However, you can't ask your accounting people to race around and calculate what would happen if you changed your depreciation methods every year and picked the depreciation method that yielded the highest profit. Auditors will catch this. You have to be consistent. You can't flip-flop from year to year. So how do you handle it from the financial statement point of view? You use the new principle, for example, straight line depreciation in the current year, and then you go back and you fix all those assets and you make a one-line adjustment. So let's show something called comprehensive income. Most revenues, expenses, gains, and losses are included in net income, plus discontinued extraordinary items and accounting changes, plus changes in unrealized investment gains and losses. And we talked about those in Chapter 12, where certain investment gains and losses are put in the stockholders' equity section of the balance sheet. For the purposes of calculating comprehensive income, we would include those gains and losses. And that's a special section below net income, and that is just a disclosure. Again, comprehensive income is not used for calculating all those ratios we saw in the last part 3 of Chapter 14. It is just additional information that helps the reader understand some of the other issues going on in the company. So again, quality of earnings, earning power, they're similar concepts. The substance of earnings, what is it made up of, and then their sustainability into the future. A company that has a high quality of earnings provides transparent information that doesn't confuse readers and it doesn't mislead readers. Now, companies often have incentives to manage their income or to try and beat Wall Street. If they come in higher, their stock price will rise, they'll make money in the market, the individual managers will make money. And then, of course, the stock options prices will also rise. So it's important that companies have a high quality of earnings and that they don't try to trick Wall Street, because that's essentially fraud. So quality of earnings can be reduced by different accounting methods. We have something called a pro forma income statement. Pro forma income excludes items that companies think are unusual or non-recurring. That's great. Again, companies want to focus on the positive, the point being that you have to avoid abusing that and really reporting profit when you haven't made a profit. Years ago, Amazon had a press release in which they said first quarter profit. And turned out what they were calling profit was income from continuing operations. They were not calling net income profit. In fact, there was no net income profit. It was a net loss because they had some discontinued operations, some extraordinary items. But they led the stockholders to believe that they had made a profit. And of course, it's true. They should have sent out a press release saying income from continuing operations for the first time is profitable. But it was misleading. Finally, there's a lot of pressure on managers, presidents, CEOs, and CFOs to manipulate numbers. There are all sorts of tricks that companies have done that are in fact illegal. For example, improper recognition of revenue, channel stuffing, shipping product out to your retailers that they didn't order and calling it a sale. Do it at year end, and the whole problem doesn't get resolved until January when the retailers ship the product back. This is called channel stuffing, and it is illegal. WorldCom participated in capitalizing its operating expenses. What does that mean? They had operating expenses that should have been put on the income statement in the current period. Instead, they called them an asset. What does it mean to call them an asset? It means you depreciate them at a much slower rate. And of course, in the case of Enron, they failed to record liabilities. They did something called off-balance sheet financing, among other things. They did a lot of things at Enron. This concludes Chapter 14. Following are the solutions to the Kellogg's analysis and what really happened at Kellogg's. Okay, we were talking about Kellogg's financial statements in 1998 and 1999. What really happened at Kellogg's? We saw their sales going down, we saw their costs going up, and we saw their sales, and I think it was sales and marketing costs go up significantly. So let's take a look again at Kellogg. Now, when sales go down, cost of goods sold is a direct cost. It should vary proportionally with sales, and it didn't, not by a long shot. So that's a question we want to ask. Why is this trend happening? 1998 selling and administration went up 2.6% compared to the prior year. Again, why did this happen? If sales went down, why are their selling and administrative costs going down? What happened? Well, in 1997 and 1998, big bags of cereal hit the supermarkets, and they didn't have the fancy box. They didn't have toys inside the bags, but what they did have was more for your money. A box of cereal in 1997 and 1998, a big box of Kellogg's Corn Flakes, cost close to $5 a box. And it was usually about a 1-pound box, 16 ounces. This bag here of Frosted Flakes cost about $3.50 to $4, and it contained 24 ounces of cereal. Now, depending on who you are, you may prefer to buy the cereal in the box, or you may prefer to buy the cereal in the bag. Kellogg's made the decision not to participate in releasing bags of cereal under the Kellogg's brand. They felt that would weaken their brand. Their argument was that their cornflake cereal is premium, fresh, and in a box. Customers will pay more for a better product. It didn't work. Customers switched to the cheaper cereal. Now, when I was in my classes in 1998, I would ask students, which would you prefer? And you could divide the classroom down the middle. Half the room would say, nope, the box is better. Half the room would say, the bags are just fine and just as good. When I probed a little deeper about the students that liked the boxes, it turned out they weren't actually paying the bills. So they were more brand loyal when they didn't have to balance their checkbooks. But students who were on a budget clearly recognized that the bags were a better value. Well, Kellogg's response was to spend more on advertising, and you can see this in their growth in selling and admin. Finally, and you can see this in 1998, sales went down because of a price decrease. So it reflected in lower dollar sales. But costs didn't go down, they just lowered their selling price. And of course, the end result was lower net income. Now, you wouldn't find this information in the income statement itself. You'd have to probe a little deeper. But the important thing is when you look at the income statement, you can ask the questions. You can't answer them, but you can ask the questions. Thanks.